Hi, welcome to today's video and thanks for joining me. Today we're going to be looking at part 5 of our 5 retirement myths. Today is the 5th one, but if you haven't gone and seen the first 4, I encourage you to watch the first 4 and then watch this. You don't have to watch them in order, but make sure you watch all 5. There could be 105 myths, but these are the top 5, so I hope you enjoy it. Today's 5th retirement myth is you don't need life insurance in retirement. That is the myth I'm going to help to dispel today. If you're near retirement or you're in retirement, you likely have no debt or very, very little debt left. The kids are growing up. I mean, what do you need life insurance for, right? And I'm going to share with you some information that might make you think differently about how to use life insurance. Most people think life insurance is something that you get when you're younger, and it's not for you while you're living. It's for the people that come after you when you pass away. That is true, but I'm going to share with you something that is so powerful that it may change the way you use life insurance. So stick around. There are 3 uses, so stick around to the 3rd one, okay? That's what you're really going to take notes on, because you're going to want to know how this works for you or if it could work for you. Okay, so we're going to examine how life insurance works in retirement. And so the question really is, what does life insurance do? It's a pretty simple question, and the answer is very simple. Life insurance multiplies money. You put $1 into life insurance and it's going to 3x or 10x your money depending on how old you are, your health condition, if you're a male, female, smoker, non-smoker, and your general health. Depending on those types of factors, it could 3x your money, meaning 3 times that $1, or 10x your money depending on your age and so on. So that's really the main principle behind life insurance. It just multiplies your money, and it multiplies it in a tax-free basis. So the outcome is, instead of like an investment account where you put $1 in but you pay tax along the way, life insurance is you put $1 in and you don't pay tax on the death benefit. That money comes to you tax-free. So it's not just multiplying, it's also creating a tax-free outcome for you. So it's very, very powerful. Well, let's get into the 3 uses. Remember, stick around to the 3rd use, because that's really what you're going to want to take notes on. Well, the first one is covering off early death. That makes sense. Look at this picture. Beautiful couple, and they've got this beautiful baby, and their whole life is in front of them. You remember, if you were able to have children, you remember that this moment in your life you're in your own little bubble, your own little world. This was very like a magical moment for everybody. What could spoil that, obviously, is an early death. So you wanted to protect the other people that are the spouse and the child. You want to protect those 2 individuals should you pass away early. So that makes sense to get life insurance, and not just enough to pay the mortgage. You want to consider other reasons why. I'm going to get into that. So you want to think about how life insurance is going to be used. So income replacement. Whether you're the breadwinner or not, your income is now lost to the family, and you want to replace your income. So you want enough insurance that's going to replace your income, whether it's 10 years worth or 20 years worth. We're really talking about budget as well, how much you can afford to have. You may want to retire all or part of your debt so that the survivors can stay where they are and still be able to afford having the assets that they have, or the debt that they have. You may want to fund their lifestyle goals. So person passes away, and not only is there a loss to the family, it's very hard to grieve the loss of a parent at a young age, but imagine having to uproot that family to go to a different neighborhood because they can't afford that neighborhood, or they have to leave that school because they can't afford that school anymore. So you don't want to just provide enough money to pay off a little bit of the debt. If you can afford it, you want to be able to say, not only do I want to make the debt more affordable, but I want you to stay where you are because that's a good, safe community, great neighbors. It's a great environment for the kids to grow up. It's close to maybe where you work as well. So there's reasons why you would want to have money beyond just debt replacement. Education goals. You're no longer there to fund RESP plans, to provide enough money for the child to go on to secondary education. So that might be also one of the goals you want to fund. And retirement goals. And people say, my goodness, what, you want to have enough money to retire my spouse in 30, 40 years? Well, think about this for a second. You may be in a situation where you decided that one of the spouses is going to remain at home to have children, raise the children. You didn't want to go through the daycare option. You didn't want to go because daycare is expensive as well. You didn't want to have a nanny raising the kids. You wanted to make sure that you were giving as much of your time to impart your own family values to that child. And so one of you went to work and upgraded your skills and moved forward in terms of your acumen for your work environment, and the other one didn't upgrade their skills because they stayed home and raised kids. So now through a passing, if there isn't enough money for all of these things to happen and they have to go back to work, well, they're kind of been in a disadvantage. The deal was that you were going to make sure that you could provide enough income to provide security for this family, and through passing and not having enough either assets or insurance, you broke the deal. Now what am I supposed to do? Now I'm supposed to be able to try to upgrade and make enough money to support the family. So I want you to understand that it's kind of a contract that you're making with your spouse. When you say you stay home, then you got to make sure that you have enough. It doesn't matter whether it's male, female, or male, or female. I'm not talking about that. I'm talking about you make a contract that one stays home, then you got to make sure that you fulfill that contract to protect them, and so you should have more insurance for that goal. So that's my little soapbox on that. And now the second one is estate planning. You get to a point in your life where you're thinking about how much money you want to pass on to the future generations, and legacy too. You could want to make, let's say, charitable contributions. That was something you did while you were living. You gave money to certain organizations that you have some affinity to, and you want to do that at your passing as well. Good idea as well for the tax deduction. But what if you wanted to maximize your estate? Well, life insurance is one of the easiest ways to do that. And I always say to people, like, if you want to go out and build all these assets, work hard, put your money into income producing assets, those assets grow, and then at some point you're going to pass those on to the generation. That is hard work. I'm not saying you should move away from hard work, but there is an easier way to provide enough estate value, and that's just simply buy enough life insurance. You have the job that may not be able to provide enough assets because your income is maybe a little bit lower, or you don't see yourself ever getting to a point where you could make enough money to make your assets bigger. So buy life insurance. It's the easiest way to make your estate value higher. But the other reason about estate planning is very simple too. Taxation. Look at this. This is an example of an estate where they've got about $500,000 that they're going to have to pay to Canada Revenue. Now the question would be, do you care? If you don't care, then the money goes to Canada Revenue and less money goes to your beneficiaries. But if you do care, if you're the kind of person that was trying to pay the least amount of money to Canada Revenue all your life, and then through your passing you gave it up, then they won in the end. So what I would say is, this is where you'd want to try to mitigate that tax. Now you could do that while you're living with a retirement plan. I encourage everybody to get a retirement plan because there are things that we do, there's strategies that we employ to lower your taxation year over year, and also your estate plan. But the other thing that you could be doing is just having enough life insurance that would replace the tax loss. That's what this is. This is tax loss to your estate, and the life insurance pays out, and then you would have a replacement of either all that money or more, or at least part of it. So that is the other goal for estate planning. Okay, now on to why you are here today, and this is the one you got to take notes and pay attention to. And I'll try to go slow, but I know I've heard you and you said, get on with it. I want to hear everything, but I want to cover off all the details so well that I don't want to go too short, right? But let's take a minute and figure this out together. Life insurance, whole life insurance, is considered an alternative investment. Why is it considered an alternative investment? Let's look at this. Well, you could take money that you've got in a non-registered plan that is, let's say, fixed income, right? And that money is 100%, if it's in bonds or GICs, it's 100% taxable. So there's no help from the government on this part. You're gonna have to pay 100% tax on the growth of that money. When you deposit money into life insurance, whole life insurance, and you receive a dividend in that, and I'm saying whole life, not universal life, don't confuse this strategy with universal life. This is whole life insurance. When you deposit money into that kind of policy, you're provided a dividend every year, and that dividend in your cash grows tax-free. You don't have to pay any income tax year over year the way you do in a non-registered plan. So it could be a tax shelter, right? So when you look at this as an alternative asset, think about all of your assets, and let's look at this together. Equities, so stock portfolio, fixed income, bonds, and GICs and cash. Then you've got real estate, could be just your home, could be your home in a cottage, could be a bunch of real estate positions, but that's what that green section represents. And then the other wedge, the insurance wedge, is saying, okay, how much life insurance do you really need for all kinds of insurance? But in particular, the one that I'm talking about is growing the cash value. So the strategy, which I'm going to show you now in a minute, is taking some of your non-registered money that is slow, right? It's low return, low risk, and 100% taxable. You take some of that money every year and deposit it into whole life insurance. You're just transferring it laterally. It's not like that money is gone. It's still there available for you, but when you transfer some of that money every year into insurance, that cash now is now not being taxed in your hands, and it gets to compound on itself without any taxation, and you get to use that money later on. And that's what I'm about to show you. So pay attention to this, because this is going to blow your mind if you've never seen this before. This is going to make you rethink how to use non-registered. Who would use this kind of strategy? Just before I get into it, someone that has a large non-registered portfolio, someone that has like a high income earner, someone that it might be receiving a large amount of money from your parents when they pass, so you're expecting a large amount of money. Typically, or you're doing a downsizing event, you're going to have a large downsizing mean going from one residence to another, and you're going to have a large amount of money all of a sudden in your bank account and go, what do you do with this? You're being taxed on it. This is where you can use life insurance to maximize your estate, to grow your cash values, and to generate tax-free income to you in retirement. So you ready for this? Because this is going to blow your mind. Let's dig into how this works. I'm going to share with you now, side by side, investing in a non-registered account versus investing in a whole life. You might have heard it, a participating life, same thing. But let's look at this. On the left-hand side is what we call the alternative investment. That's just like a mutual fund portfolio, stock portfolio, it doesn't matter, but it's non-registered. And in this example, you're depositing $1,000 a month for 20 years. That's $240,000. You see that there on the left. That money goes into your investment and it produces a return, and it's fully taxable. It's a non-registered portfolio. And then at a certain point in your life, you decide, you know what, I want to use that money to supplement my retirement. So let's say that you want to use that money before you pass, obviously, over a 15-year period. So you're going to start taking that money out. The average age in Canada is around 85, 86 of passing. So let's say you start taking that money out when you're 70, as an example. That you don't have to, it could be earlier, could be later, but just as an example, so we can compare the two. So at age 70, you start doing withdrawals of that non-registered account, and you're paying tax on that money. And that money is going to come to a total of about $490,000 worth of withdrawals that you're going to use in your hand. And remember, you pay tax along the way, and then at age 85, 86, the person's passed away, but you have no money left in that account because you completely drained it. You said, I want to withdraw right down to zero over that 15-year period. So you actually give $0 to your beneficiaries at that time. You got to use the money, you paid tax, but you give nothing to your beneficiaries. Let's go to the other side. It's called ERP strategy. So this is really cool. Same dollar amount going in, $1,000 a month for 20 years, $240 deposited into a permanent life insurance policy. But because the money is going into the policy and stays in the policy, you actually don't pay tax on the growth of that money. So same dollar in, but what happens is, you can see here, you actually are going to take lines of credit, so you're collateralizing the cash value, and you're going to take lines of credit totaling about $550,000. Now, that money is coming to you. A line of credit is not taxable in your hands. It's tax-free money. So yeah, you've got a loan, but you also have life insurance ready to pay off the loan when you pass away. So you end up getting more money to use in your lifetime. You didn't have to pay tax. And when you do pass away, look at the bottom of that page, $1.3 million goes to your beneficiary tax-free. So all the lines of credit that you took out have been paid off, plus 1.3 million goes to your beneficiary. Now you tell me something. I'm just gonna wait for you to answer this question. Put your comments below. I'd love to hear your comments. By the way, if you're one of our American viewers, this doesn't work in the United States because you pay tax on your life insurance. Here in Canada, we don't. So that's why this is a great country for you to do this kind of strategy. Put your comments below of what you think about this. I want to hear your comments. Do you think this is hocus pocus? This is like some kind of magic? This is the tax laws in Canada. This is the way life insurance works. If you haven't heard of it, it's because you're probably dealing with somebody that doesn't offer life insurance or doesn't do any retirement plans or estate planning, or they're just not licensed, so they never bother to tell you, hey, you know, there's an alternative way to do this. So let me ask you this question. If you could put the same amount of money into this strategy, one on the left, one on the right, but the life insurance has an amazing, remarkable, like it's not even close difference. The outcome here isn't even close to the non-registered side. Why would you put your money into a non-registered plan? Not all of it, right? We talked about the part of your fixed income, just a piece of that every year, transferring it into this strategy. Why would you keep your money in non-registered? You had access to it. You can see you're taking the money every year. Why wouldn't you do this? You have more money to use, don't pay tax. Because it's not tax-free, it doesn't increase your old age security, so it doesn't cancel out your old age security and get a clawback. So it's a great way to mitigate that. It allows you to push off different assets like CPP and old age security and use RSP meltdown strategy, because you've got RSPs coming in, then you got CPP and old age security, and then you've got this life insurance. So it allows you to really use your money in a different way. So this ties into your withdrawal strategy very, very well. So I hope I'm blowing your mind with that, because I love talking about this, because it is one of the most powerful tools you could use for your non-registered portfolio to grow your cash value in a tax-free environment that will supply you with a really great income source later on in life, and then a great death benefit for all of your estate goals as well. I hope you enjoyed today's video. Thank you for watching all the 5 videos. Remember, we take care of your wealth management so you can take care of what's most important to you. Thanks again for tuning in, and I look forward to seeing you in the next video. Take care.